Today's date, 12/1/2012. Merry Christmas to everyone. What do we have before us? We have the S&P 500. What are we going to cover? We're going to cover this weekly chart on the S&P 500. And the reason why is because we're also going to cover the daily as well. So, when we got deeply oversold, it was a deeply oversold Christmas combined Thanksgiving Christmas combined rally on the S&P. Everything was short-term oversold. Everyone has a pent-up demand that Congress is going to do the right thing. December is a very cautionary month. There's going to be very, very high price volatility that's going to start Monday, 12/3. We'll go through the calendar month of December. We can tell you that when we were deeply oversold on the S&P, we called it, and our target was 1345. Now, let's talk about these particular lows that the S&P put in a very longer time frame. This 1350 used to be a wall of resistance back in the bear days. What we want to tell people is that if you're involved in this market right now, the market is very complacent. It's in denial. The market's in denial. And the bull is in denial. Why do I say that? They put too much hope. And too much hope into what? The fiscal cliff being resolved. And what growth would look like. We're telling people right now that volatility is going to increase. We are also going to talk about what the S&P is any upside volatility. Now, it works both ways, but let's say that they were to do the right thing in the S&P. Our target where this S&P is around 1450 from where we currently are. However, we're going to have to clear that 1425, 1430 is going to be that shorter resistance area, which in return would be a total V-shaped recovery from where this part of the selling started here, and we come straight right back up here. This is a V-shaped pattern on the S&P 500 on the daily. We are not back into a daily buy signal either. Now, when we get over here to the weekly outside of this daily chart, we can take a look at it because this weekly tells the tale here is that the 10-week moving average is a wall of resistance. We'll go right over here to the neckline, right across here. That's going to be 1436 on the upside volatility before we get a reversal. We haven't hit a 2012 weekly sell signal because we started out calendar 2012 with a bull run last year in January. That's not going to happen this January. The chances of that happening out of 100% are 5%. I would not give it any more weighting than a 5% weighting that we could continue another calendar 2013 January like we did 2012 here. Yeah, we were putting in all-time bottoms. They walked the tape up. We got look at, we had 5.5-year highs up here in the S&P. We hit our target at 1475 because we did. Now, capital gains, interest rates can go higher. Inflation is going to be a problem next year in calendar 2013. That means that January, February, and March, that quarter, we could see where the S&P could make lower lows than where we, and that low that we're talking about will ultimately come right back over here. That's 1259. Just call it 1260 on the S&P. That's where January of 2012 started. This was the correction that we faded. That means that you make money when it goes in reversal. Then it came back and it made all-time highs. The problem moving forward is why could the S&P go dramatically lower? The upside in the S&P is going to be limited. unless there was a miracle, and I will literally use the word miracle, is that 1.6 trillion tax hikes, small businesses are going to be affected, Obama health care, capital gains, many various different things that are hidden that people don't really quite understand. What I can say in this environment, that every oversold market in a shorter time frame has relief rallies. December is going to be very volatile, more so than November. The headlines coming out of the White House can cause these markets to sell down and come right back over here and break this weekly low that was set, let's just call it during the week 11/11 of 2012. That was a weekly low here, and we've come up 1 week, 2 weeks to the 10 week, which is declining. The 50 week is rising. However, the most important lesson to be learned here is how to make money in the month of December and January, because January could be a very bad month for the markets, meaning that we could go back into a mild recession because of the activities that is being done in the White House. The Republicans have tried to come over and help the Democrats. The Democrats are not willing to help the Republicans. They're at a stalemate, kicking the can down the road. They like to come out with these deals right before the end of the year, but with the stalemate and the ridiculous proposal that the Democrats even came back, which was much more ridiculous than the first one. I mean, this last little bout when Geithner went up there on Capitol Hill and went to the Republicans with this ridiculous thing about, hey, the deficit is a problem. They want to increase the spending. They're not making these entitlement cuts. That's just to start with. Whereas we know that certain things that are going to get implemented are not healthy for the economy. And that what happened over here, we could have the very opposite, which is more highly likely at this point in time. That the month of January 2013 is just the opposite of this bull weekly run. You're going to have lots of selling and lots of volatility. It's going to start right now on Monday, December 3rd. So, basically, they got to come out with the deal. They could wait until either right before Christmas or after Christmas. They go right down to the end of the wire. They're at a stalemate. If you were in the rally, you didn't get out when it had a correction, sell into it. Don't put your hope on them people. So far, the track record is not good. Therefore, what we're telling people is that in calendar 2013, not only do you have a problem with how small businesses are going to operate and hire people in our economy, but what about inflation? People forgot about that. And let me tell you something. If interest rates go higher, well, that's, QE3 and QE2 and all of the injections that Mr. Bernanke has done is his fears about those rates going higher. Because if the rates go higher, then the money's not as cheap. And there's lots of money out there that can be used, but people don't want to take it because they don't know what their future is going to be. And the United States government isn't supposed to cause this kind of uncertainty. When it comes to the equity markets on Wall Street, the old saying is, let's sell and ask questions later. And that's exactly what happened here for several weeks. Yes, every sold bull run gets oversold and has a relief rally. And everybody would like to close out the year up toward the highs. But virtually impossible. Don't bet on it. What I'm going to tell people is that the volatility in the S&P 500 is going to increase. January is going to be a potential month now where it can turn out to be very, very ugly for the bull. Should that be the case, you would go to StockMarketFunding.com and you would look at what? What would we have you look at? How would you participate in the failure of the government and come out a winner? Called bear funds that we covered a couple weeks ago, and we hadn't pulled them out of the suitcase for quite a long time because we hadn't. We know that the bear funds, which I will be happy to put here in the video, these are all bear market ETFs. And a couple of weeks ago, we started updating these. Now, should your government fail with the fiscal cliff, that means that a lot of these bears that rallied have pulled back to their support levels when the market, so they made their rallies up to resistance and the markets put in a bottom. When the markets and the indexes rallied up, the bears have pulled back to their bases in their chart patterns here. We've covered a lot of them. You don't have to be a victim of the market. Here's a DOG. It's a Dow 30. And I covered the Dow 30 earlier, but there are ways that you can participate should the government fail. And these bears have been out of favor forever because we've had a great year of bull runs in calendar 2012. And for a number of years, these bear funds have sat on the sideline and actually haven't done anything. But they put in a weekly bottom in this one. Look at, when I'm talking about the S&P 500, which one do we like? Well, let me tell you which one we like. Here is the SH. That's a bear fund of the S&P. So if we go into a severe sell-off and volatility is that these are at their all-time lows. This would be the place, and they made their highs up here at 36 and they're pulling back on the weekly area. This is how you would do the S&P 500 using an ETF. Because you don't want to sit there and be a victim to the selling. But if there is that next selling that is potentially just right around the corner, that's what we see, then when these pull back on the weekly charts and they set it up, they can break their all-time highs over here. They were $39 over here. Now, that's just there's another one that we would like to show you that's relative to the S&P. So we have this one here that I'm highlighting in the video. We also have another one called the it should be in here. Let's take here. I'll type it in here. SDS, ultra short S&P 500. That's another bear fund that can be bought when the S&P would sell off. You can see here in the weekly chart, because of the performance of the S&P, is that these bear funds down here had made their bottoms, because they have. They rallied up here to $60. They pulled back since we rallied up for Thanksgiving, and we had a 2-week rally from an oversold condition. These tested their resistance levels. This is a weekly consolidation, and they're pulling back to the weekly moving averages here. What we're going to be monitoring carefully is how these bear SH, SDS, relative S&P 500, is how these things set up their bases and how these things can come back over here to $72. That's a big move up here now. Here's another area of resistance of $66 now. And that these weekly bases have made their rallies. They have pulled back like they should. What we look for is the fiscal cliff is not resolved. They have a stalemate. The volatility is going to be high. That's what these look like on a weekly level. Back to the S&P 500. Weekly chart is that we've rallied up to the wall of resistances. We're testing the 10-week moving average. We've had 5 days up here and 5 days from the bottom up here to the declining 10-week, and we're right at the 20-week simple moving averages. The upper end of these weekly resistance levels will be the ultimate cap, 1427 by 1430, 150 is going to be a major wall of resistance now. The upper end of the weekly consolidation breakdown would be this weekly trend line that comes right across here where these two weekly bars are. If we break up and test that, that's going to be that wall of resistance. December is historically the second best month of the year where people are buying stocks, filling their stockings for Christmas, getting their positions, getting ready for the next bull rally. We don't see it. What we have is an extreme calendar 2012 bull rally that was wonderful. That's how we started off a year ago. The problem that we see is that the S&P held our support level of 1350 here. That was the support level that we told everyone that we were going to test when it was up here. And all the live videos and analysis on stock market funding is there. We were correct. And it was before the fact, not after. What we will tell people is that you have a right to participate should the government fail, which we see happening. And they could kick this thing right down to the very last days of September. Will it be enough? Probably not. What we are going to do is give a high alert. The bears need to be looked at, because if this thing goes the wrong way and we go into a mild recession, that we can see the likelihood of that happening without a deal is probably 98% probability now. You go into a mild recession for the first quarter of 2013, the S&P, let us not forget that the 2012 low over here, let's take a look at it now. This is where our lows were over here on the S&P, 1276. That's that 1 week, 2, 3, 4, 5 week down to the bottom. That was the correction of 2012. During this pullback here, we never even broke that support level, but I will guarantee you one thing. 1300 is 100 handles lower on the S&P. We would have a lot of selling in parts of December, but more importantly, going into calendar 2013 January trade, this thing with the mild recession is going to put this S&P right back down here at these lows of 1275. That's a big haircut. But that's where the calendar 2012 low was before we made the 5.5-year highs up here. Now, granted, it's much more bullish right here on a pullback because it didn't break the support level. This is just a relief rally. But let me just tell you something right now. The volatility for the month of December is going to be big. And the thing about it is, the market's in denial. It's complacent right now. Who doesn't want a good outcome? We all do. But the problem is, we can't seem to get it out of the people. And pro-growth versus anti-growth, what does that mean? You got to have pro-growth policies. They're not coming into play. They're not cutting spending. They want to add entitlements when they said they were going to take them away. I'm just going to tell everyone here and now that we will be trading these bears relative to the S&P 500 here, because that's where we can make money when they fail. And you can participate too. There are lots of different bears in here in various different sectors. We pulled them out of the suitcase a couple of weeks ago. And we started looking at them, where their breakouts were, how they rallied up to resistances, and how they're pulling back. And this is the wall of resistance on the S&P 500. One of the other things that we're going to look at here very carefully is this beautiful trade that is called the S&P 500 index. If I'm going to be buying the bear, then I am going to be also trading the put side, which is the failure side of the S&P. When it goes down, the puts go up. And what would we be looking at? I'll be quite honest with you. We would go over here to January, and what are we going to look at is where our risk of where that 1275 support level is. Now, we have covered some of these open interests now, and the calendar monthly open interest at the 1300 is 87,000 contracts there. we would be looking at this $1,300 put on the S&P. Now, look at the lows over here on this thing is $6. The last high over here was $25 a contract. It's a January $1,300 put. The S&P drops $100. These put options go way up in value. So we will monitor the volatility. We will monitor that January trade. We can see that our current high on the contracts were way down here. These could have been bought, believe this or not. These could have been bought down here for very, 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 very cheap. They're historically coming down to lows in here on this put contract, 1300 January one. When we look at trading this side, we look at where the dollar capital risk is at its very lowest level. People that were buying the puts up here, you're buying 10 contracts at $20. Hell, that's $20,000 on 10 contracts. They're only worth $6,000. We would like to be able to get into these contracts at the very low bottom should the S&P fail like we think that it will, and volatility is going to come into play. It's a January trade. Because if this goes higher, your bears go higher, SHSDS. How do I participate in government failure? What I am telling people, historically looking, and I pointed this out, this is called the Volatility Index, the VIX, CBOE. Why are we throwing it in the video? It's all part of the grand scheme. When I say that the markets are in denial and they're complacent, look at here. Everybody's put too much faith in the government, obviously. We're at weekly historic lows, which says that people are very complacent. People are in denial. And that people do not have any fear. When these things break out, markets break down. Now, granted that in other periods, when these things break higher, markets go down. We're at low levels going into this fiscal cliff. And this is the problem that the bull is going to have to deal with. Because they're at high risk. And the thing about it is that when this fear indicator starts moving up, these were the last highs up here at 20. It's pulled back to 14, right back in this weekly base where they break out. When these things break out to highs like that, markets go in the toilet. But then when the VIX goes down and fears goes down, then bull rallies rally up. So we had to throw this in here right along with this S&P 500. We've also concluded that you have a right to not be a victim of the downside and holding long in the S&P. But you have a right to take advantage and understand what that trade management would be. And how will you ever really understand that? Well, you'll have to come and visit us here. That's how you're going to understand it. And so the risks are elevated as we rally up in the relief rally from the oversold levels within this last correction is that there's a big cliff below the market. All the way back over here, 1100 is where we were last year at this time when we had this great rally. This is what okay, so you rally up, you come back, you test it, then you rally all the way up in calendar 2012. But listen, this low right here is going to be tested. And not only that, the lower lows down here where all of this started a year ago could totally be unwound this coming January. We're not joking you. We're telling you, because we care about investors, we care about traders, we care about everyone who's involved in these markets because you're a victim and the markets have been held hostage by the government. And that these lows last year in 2011 where everything started on the upside, there is a big, big floor below this market. And the upside to this market is limited. The upside in the S&P and the exchange is limited to the upside. So look I've got a whole lot more downside that can come into play versus the upside. And I will tell you that everything that started back over here can totally be unwound, and this S&P could drop horribly in the calendar month of January and February. And not only that, in the month of January, we could really make these lower lows, but most importantly is starting December 3rd, we're going to take a look at where that 10 week and that 20 week is. They're going to try to get this up here, and we got certain areas that I just described herein is that any good news is going to be sold, because a lot of the oversold rally and people buying is that part of this Christmas rally is being factored in here. I'm telling you now that the markets are complacent, the markets are in denial. And yes, everything gets a relief rally. We hit our lows here that we said we would. We're back above the 50 week and we're at the major wall of resistances. So stay standby. We're saying that calendar 2013 does not look good for the S&P right now. It is going to take a miracle for these people to do the right thing to start a new bull market. The thing about it is, sometimes you have to go back into a recession for a while until people do the right thing. This is the way that we're probably going. Unfortunately, the two parties can't get out of themselves. We think that the Republican has a fairly balanced approach, but a lot of people don't understand what these tax increases do to our economy. Not only that, the Obama health care and small businesses. So therefore, I've given the analysis here. Stay tuned moving into the month of December.